Good afternoon, this is Todd Colvin coming to you from the floor of the CME Group. We are talking rates, and those 10-year note yields keep going down. Actually, looks like a new year-to-date close on the cash yield 2-year just below 212. And I think right now, if you just look at where we've come, how far we've come since March, when yields were marking close to 260 and the Federal Reserve had just raised rates, we are now down close to 50 basis points in 10-year yield, pretty much on a pretty steady trend. And I think right now that as we go forward, there's a lot going on, and with yields kind of on the lows, it kind of just shows you where the risks are and where the demand is right now. And if you look at volatility is telling us, again, another story. We have been seeing volatility trend lower in the Treasury market, which would suggest sticking with that trend. And today we did see a little bit of an uptick in volatility, and actually we've seen a little bit of an uptick all week. Not much of an uptick, but when you see volatility move higher, it means that we're probably going to start to revert away from the trend. And if we see yields continue to go lower, why would volatility then all of a sudden go up? Well, because we're going to break out of the range. The market's anticipating we break out of the range, which would be making new low yields, or we bounce higher, which would be going against the trend. So there's a kind of in a catch-22. Volatility should go higher here no matter which direction we go. And looking, and right now with the fact that volatility is bidding heading into the weekend, I think it's looking past the non-farm payroll. It's looking past some of the data we have on Friday and looking more at the long weekend, holiday weekend in the U.S. It's also looking at potentially some of the ramifications of what's going on down in Texas with Hurricane Harvey and costs and whatnot, and getting people back into their homes. The market just seems very unsure right now of where things are headed in that direction. And if we look ahead, what's going to happen tomorrow? What are the key things to look for? Obviously, with the non-farm payroll data and with the wages, but I think ultimately it comes down to two yield levels we're going to look at. 210. If we can get below 210 and settle below 210 in yield, that's going to be a breakout of the range. That's going to be significant for momentum. It's going to be significant for where we see bonds going. Lower yields in the face of higher rates from the Fed is something they do not want. And if inflation isn't going to play along, and if growth isn't going to play along, obviously yields are going to go lower. But then there's also a risk factor that we've seen here, whether it be from North Korea, whether it be from Mother Nature, or whether it be from something we don't know yet. There is a sense of risk being priced into the market. On the flip side, I look at 2.25 yield, which would be a retracement of the recent push lower, would reverse what we've seen, and it would certainly, if we get a strong payroll number and we get some big selling, whether it be in the 10-year or in the 30-year, but we see buyers come in the risk assets like stocks and others, that would be certainly a sign that things are okay and maybe that risks are abating. So if we can get to 2.25, which is a big trade, it would certainly mean that we're probably going to start to see things go back towards those higher yields on a more consistent basis. But again, those are two pretty wide ranges. You're talking about a full point in the 10-year futures, or you're talking about 15 basis points of yield. That's a big move. So we have employment tomorrow. We do have some key thing, other data, as well as the weekend risks. So there's a lot that can happen. And if you really just take where we've come to where we are, we've made a very big move. So reversal certainly seems like the likelihood that we would happen on a strong number tomorrow. However, the market does what the market does, and I'm going to wait until tomorrow afternoon to see exactly where the dust settles to make a final estimate. And I think right now the bullish sentiment in the bond market should remain, at least for the weekend, given the risks that we have over the long holiday weekend in the U.S. And then next week we might see some more normalization. But 210, 2.25, those are levels to look at in yield. This is Todd Colvin coming to you from the floor of the CME Group.